We're Compound Everything, and today we are talking about margin of safety. And a couple of videos back, we talked about how to assess management, and we also talked about moats and how to find them and how to distinguish what moats a company has. And today we're talking about margin of safety.
It's basically getting a dollar value that you should buy the business at.
Right.
In essence.
Right.
Yeah.
So a margin of safety just means that we're buying at a price that gives us a safety net.
Right. So you can calculate what you think a business is worth, but the whole point is to buy a business for less than that.
Right.
Or at least pay a fair price. You don't want to get ripped off.
Yeah.
You don't want to get ripped off when you buy a car or a vacuum cleaner. You really don't want to get ripped off when you buy a business.
Yes. So why would we be so focused on finding a margin of safety? Why would that be something that is so important to us in our investing practice?
So a lot of value investors say, look, I can calculate an intrinsic value for a business, or a lot of people will calculate a range of intrinsic values for a business. And a lot of value investors say, you know what, I could be wrong on this. And so when they are calculating their valuations, they come up with numbers. Again, either a strict number or more often a range of numbers. And they say, you know what, because I could be wrong, I want to pay 25% less or 50% less than this. And that's my margin of safety in calculating the value for this business. That's my buy price.
Yeah. And a lot of times you use a margin of safety, because like you said, they are not exact numbers.
They're not exact numbers. So business valuation is more of a art than it is a science. I think it's both. It's both an art and a science. You can come up with exact numbers, but if you're rigid on those numbers, oftentimes the future doesn't play out like you might assume.
Exactly.
Yeah. So when you're doing something like a discounted cash flow valuation, a small change in a percentage of numbers or a small change in numbers can lead to a very different valuation, generally speaking. So if you view your business as growing at a 10% growth rate and it actually grows at 8%, your valuation is going to be over by quite a margin.
Exactly. And that's something to be said actually right from the beginning is you can make a company say it's a buy at any price if you just move numbers around.
And you can play around with the numbers all you want.
Right. And so when you're calculating a margin of safety, you have to make sure that you're not purposely changing numbers to make sure that it fits within your target price, or to not make it look like it is a margin of safety when it is in fact definitely not. You can give it a growth rate that is way too lenient. You can discount it by not enough. There's a lot of numbers that you can change. So we, on all our calculations, we really like to err on the side of safety. We said a margin of safety is used because it's more of an art, not a science. And it also, the other reason to use a margin of safety is because businesses change, the macro environment changes, there's a lot of error that we as humans make. There's things in the business that we don't know because we are not actually part of the business. So a margin of safety, a good margin of safety, should protect you most of the time from the vicissitudes of life.
Just going to say that quote, actually.
As Charlie Munger says, so the vicissitudes of business, a margin of safety really protects you from that.
Yeah. Because you don't know what the future holds.
Yeah.
And so because you don't know what the future holds, it's best to discount your best projections by a margin to give you that buffer.
Yeah. And there are some people who do, so in Buffettology, she runs through a discounted cash flow and uses a hurdle rate of 15%. There are some people who are so conservative that will run those numbers and then discount that to 50%.
Right. That might be a little excessive.
Yeah, we don't do that, but I'm just saying, like, if you really want to, if you're a little unsure or you really want to make sure you have a real margin of safety, then you just got to really punish the company.
Yeah, I think it depends on how seasoned you are as an investor and how predictable the business is.
I agree.
In terms of how much you want to punish the company,
yeah,
in a sense. In one of the Berkshire meetings, Warren Buffett says that he didn't say that, but he alluded to the fact that they can sometimes massage discount rates themselves. So they don't it doesn't sound like they necessarily use one specific discount rate for everything. Yeah. That's what we tend to do.
And that makes sense because not every business is created equal.
Correct. Some businesses are much more predictable than others. And so if a business is much more predictable, he might use a lesser discount rate and
Yeah.
whatnot, versus if it's less predictable.
Yeah, and one thing too, when I was first learning how to invest, like I said, I learned a lot from the book Buffettology.
Mm-hmm.
And Mary Buffett in that book always just says to use a discount rate of 15%.
Yeah.
But as you listen to Warren Buffett throughout the years of at the annual meetings and as you read his reports, you actually realize that that discount rate is not a static number for him. It's actually often it is linked to the interest rates.
Right. Exactly. If you're doing a discounted cash flow valuation, what that number is essentially is what you expect to return off that investment.
Right.
Right. And so why pick 15%? Well, because historically the S&P 500 or the broad market returns somewhere in the realm of 9 to 11%, something around that realm. So you at least want to best that, and probably by a decent margin.
Or else
so
you may as well just put your money, save yourself the work and just put your money in an index.
Right. So at that point, you might as well use a number that actually clears that by a decent margin to make it worth your trouble.
Exactly.
Yeah.
So we've covered what a margin of safety is. So I think we've kind of covered why, but we can allude to that again. So why do we not just look at a stock and then just be like, that looks like a good price, let's buy it?
So in a sense, running a calculation like this is like bumper bowling. If you give yourself an upper and lower band, at least you kind of know where your business should fall.
Yeah. Now, who was it that said, was it Charlie Munger? It was either Munger or Buffett. And I can't even imagine someone saying this now without getting canceled. But they said, I don't need to know how much a woman weighs to know that she's overweight. Right. I just can look at her and tell she's overweight. And, they were speaking of a business. I don't need to know exactly what the business is worth. I can just look at it and know if it's undervalued.
Right.
But we have found that most of the time that is true. Like 80% of the time we can be like, man, I think this is a good deal. And then we'll run some numbers and sure enough, it is. But there are times, 20%, which is just enough for us to not always rely on that and to always make sure, let's run some numbers. Let's really do a deep dive, because there are times where I think this is a deal.
Right.
And it's just really not. Or we don't think it's a deal and then it is.
Right. Now, the other caveat to that running numbers is make sure you know your business, in essence. You can run all the numbers in the world, but if you don't know what the business is about, it's probably not worth that much.
Well, and also I actually find once you start running the numbers, that's when you realize if you don't understand the business, because all of a sudden you're looking for certain numbers, or you're like, why is this number so much, or why is this number so little? Or you start looking at the growth rates and you're like, oh, I don't even know what growth rate to attribute to this company. And at that moment you realize, wow, I really don't understand this company the way I thought I did.
Right.
So there are two different methods that we use to run numbers. And one is a discounted cash flow, which is your preferred way, and you use Excel.
I use Excel spreadsheet.
Yeah. You got your Excel spreadsheet and all the formulas from
a book called Value Investing for Dummies.
So a long time ago.
Yeah.
A long time ago.
And I made the Excel spreadsheet, and I just took the inputs and I created my own spreadsheet. And as part of that spreadsheet as well, I factor in several different growth rates. So I put in revenue per share growth rates, earnings per share growth rates, operating income growth rates, and free cash flow growth rates.
Yeah.
As part of all that.
And the nice thing about Excel is that as we were preparing for this, you actually were able to go back and be like, oh, right, I actually valued this. And and one stock you're looking at is that we had valued NVIDIA. So, and that was how many years ago?
So I did the valuation in 2021.
2021, yeah.
So at that point in time in 2021, I spit out a value of $161 per share.
And it was trading
at $90 per share, or thereabouts. It would have been a discount of about 40%.
Having gone into the future, we know it would have been an amazing buy. You didn't buy, but
no.
But it's fun to go back and be like, oh, right, I valued this or I valued that. And you have used that same Excel spreadsheet. I don't think you have really for years.
Same one.
Like a long time.
Yeah, the math doesn't change.
Yeah. I use a calculator.
Right.
I am super old school, and I use a financial calculator. Not even on my phone. I use the physical Texas Instrument financial calculator.
So we ran through a company. So which company did we do?
We did Dollarama, which is a Canadian company. They're a dollar store. They've been around for ages. They're family owned and operated. And they are always busy. We see new stores going up everywhere. It doesn't matter what type of area the store is in. High income, low income, does not matter. They are always busy.
Yeah, they sell items to a maximum price of about $5.
Yeah. So it used to be that they sold to a maximum a maximum amount of $1, then it was $1.50, then it was $3, now it's $5. They have pricing power,
Very
funny
much so.
enough,
Yeah.
because they can increase with inflation and people are still happy.
So we chose Dollarama because it's a store we often frequent. It's a store our kids frequent to buy drinks and chocolate bars and things like that. I think they have something like to the tune of 1,500 or 1,700 stores, incorporated in 1992, I believe. And it's a family-founded and
they've been
run
around forever.
Company. Yeah, so around 1992, I think, is when they incorporated.
Yeah.
So it's a business that's been growing steadily, and we've been seeing stores pop up in new areas.
And one reason we decided to evaluate is because you actually did hold it.
I did hold it. So I held Dollarama
back.
Quite a while ago, and actually I did an intrinsic value and determined it was overvalued, and I sold it.
And what price? And you had made money on it, but what price did you sell it at?
I sold it at around $130 per share.
And today it's trading at?
Today it's trading at around $79 per share, but that's after a stock split.
Yeah.
And I can't remember if it's 3 for 1 or 4 for 1.
Yeah. So either way,
I missed out on some
early.
gains. Yes.
But it makes me think of two things. One, it makes me think of when Charlie Munger says, "I'm happy when the stock we sold goes up because it shows us that we're not playing the bigger fool game."
Yes, that's right.
Or the greater fool game. And actually, yesterday I was just watching an interview with Seth Klarman, and he said the easy part is figuring out when to buy.
Yes.
The hard part is figuring out when to sell.
Mm-hmm.
And so you're in good company.
Yeah, that makes me feel better anyway about it. So I do a 2-stage growth rate, which is in essence where you take in my spreadsheet, I take the first 10 years, and then I do a discounted cash flow from that. And then there's a terminal value for the remainder of the business.
Now, why would you do that? Why would you do a 2-stage growth rate for people who are watching?
So I would use a 2-stage growth rate because there's a business cycle, right? So specifically for a company like Dollarama, they're in a growth stage. So you can see over the past, call it 20 to 30 years, they're actually growing at a pretty good clip. But that's not going to happen forever.
Yeah, you can't have a Dollarama at the end of every street.
Right, exactly. I mean, you could, but they're probably not going to generate...
Yeah, they'll cannibalize their own stores.
So for me, what it tends to do is I use one growth rate for the first 10 years because I think I can predict out that far. And then beyond that, I give it a terminal growth rate, which is much, much lower. So for Dollarama, what I did is I used a 10% first stage growth rate for the next 10 years. And that's probably a little lofty, I'll be honest.
Okay.
Especially after looking at their revenue growth and a few other things. I should probably use more something like 7%.
Right. And how do you, so before we go on, how do you find your growth rate? What do you base that on? Do you just pick a number out of the air, or what do you do?
So, I mean, you can do a number of ways, but one of the things I like to look at is how's the revenue growth been? Because I don't really think a business can grow too much quicker than the revenue. So if the revenue for Dollarama is growing somewhere in the realm of 8 to 10% over the past 10 years. I also like to look at earnings per share growth rate because in part, a lot of the valuation that future investors are going to give to that stock is going to have to do with earnings and earnings per share. They're going to pay a specific PE multiple. So I kind of want to know what that is. And then I also like to know what the free cash flow growth rate is. And for some businesses, actually, you can also look at the growth rate and book value. But for Dollarama and for a lot of businesses, actually, the book value growth rate is actually negative. Because there's reasons for that, which we won't get into. But for Dollarama specifically, even a company like Apple, actually, to look at their growth rate and book value and to assign it a growth rate based on book value per share growth rate would actually probably be wrong.
Yeah, it doesn't make sense. This is one example of really having to know your business, because there are businesses where you would use book value.
Right.
And so
asset heavy maybe.
Exactly. So you can't just, exclude things for one business and then do the same for another. You really have to understand the business.
So generally speaking, I'd like to see growth and very similar growth in all those businesses, or else it gets a little harder to peg a growth
rate. Well, you
rate.
Definitely don't want to see negative growth.
Right, exactly. That might be a problem.
That would be like, I'm not even going to bother going into this now.
Right, exactly.
Yeah.
So for Dollarama, I did just for simplicity, I did a 10% first stage growth rate for the next 10 years. And then beyond that, for a terminal growth rate, I did 3%.
Okay.
Which would be roughly the growth of the economy. And so what I ended up getting was a valuation of about $30 for Dollarama, and it's presently trading at around $79. So that tells me, you know what, maybe pass on it for the time being.
Or watch it.
Or watch it,
It's a great company.
It is a very good company.
Yeah.
And this is not a financial advice. So if you're a stockholder in Dollarama, don't sell based on this recommendation.
This is in no way, we don't even own Dollarama.
We don't even own Dollarama.
This is just for fun and entertainment purposes only. And we're just going through our own personal way of valuing a business and finding a margin of safety.
Correct.
Yeah. So you built the Excel spreadsheet yourself,
yes.
and you used the template, or what would you call it, from valuation for
From
dummies.
Value Investing for Dummies.
Value Investing for Dummies. Okay,
Yeah.
so if you're interested in that particular Excel spreadsheet, that's where you can find it.
Mm-hmm.
And it's actually worked really well for you.
Yeah.
It's been pretty...
It's got some glitches in it.
It's got some glitches, and sometimes it's like, it's broken.
Yeah.
But it has kept you from making some pretty big mistakes.
Yeah.
And it has also helped you value some companies that have been really great and had some spectacular gains.
Yeah, oh, for sure, no question.
Yeah. So
Dollarama was one of them.
Yeah. So I use a financial calculator. This is actually the Sharp one. And the only reason I have the Sharp one here with me today is because we got it given to us by the Canadian Securities Institute when we signed up for the course.
Yep.
I actually prefer the Texas Instrument one, but that one's being glitchy right now. I have to reset it. I don't use an Excel spreadsheet because I get frustrated whenever a cell breaks, and
That's
it annoys me.
I know you do.
Yeah, and so I actually am so old school that I too can go back and look at companies I've done valuations on in my notebook because I've written it down with a pen and paper.
It's not a bad way to do it. Yeah.
So I can tell you where everything is and I can find it and I article it, but it is done just like,
Back of a napkin.
Yeah, the back of a napkin. So the way I do it, so let's see what I come up with.
Sure.
So I'll run it the way I would do it now and
sure.
talk through it, and if anyone's interested how to do this on the calculator, I'll kind of just run through. So I have the numbers written down here because I'm not going to remember every number for Dollarama.
Right.
Here. So first I figure out the growth rate of the EPS. And the way because I use the EPS in the calculation.
So we use EPS because we want to know what
we're going
to pay per share. So oftentimes the future price of a stock is going to be relative to the price to earnings, or relative to the earnings. But also the other reason I think that using earnings as opposed to revenue would be maybe a good way to do it is because often share buybacks are a thing and dilution, and that would actually encompass a lot of share issuance and share buybacks.
Yeah, I was going to say, that being said, this is only one valuation that we use to find a margin of safety.
Yeah.
We also use owner's earnings because it's even more accurate because net earnings can be fudged, and because of the accounting rules and GAAP accounting and all of this, earnings can be a little bit not reliable. But you know what? We have to work with what we have.
Yep.
I like earnings.
Yep.
I use earnings.
Yep.
Okay, so the way I find the growth rate, and before I even start putting the growth rate in, I make sure the same things I look at. Are revenues growing?
Yep.
Our earnings per share growing? Our free cash flows growing? Is this company going in the right direction?
Yep.
If it's not going in the right direction, if revenues are going backwards, I'm not even going to look into the earnings per share because it's probably a dying company. So before I even get
unless it's a one-off.
Unless it's a one-off, or maybe it's a turnaround, but that's a whole
much
different conversation.
More difficult. Yeah.
So I go 10 years back. I generally, if I can go more, ROIC.ai has I think 15 years back.
Yep.
That's
a great website, by the way.
It's super cheap to buy, way cheaper than Value Line.
Now, one caveat when we were valuing Dollarama is make sure you're doing things in the currency that you
would buy it in.
So for us, it's Canadian dollars. Sometimes what'll happen is it'll spit the numbers out to you in American dollars, and they won't start to make very much sense.
Right, and you're like, why is this different? But
so make sure whatever platform you're using or whatever company you're running, buy it or run it in a consistent currency.
Yes, exactly. And that was something that is probably good to share. But I like to go 10 years back.
Yep.
The reason I have 10 years, 15 is obviously better, is because when I first started doing a lot of this, which was probably back in 2016-ish. I was looking back today to see how far this went. Yeah. I was using Morningstar. Yep. And that only went 10 years back. But now that we have ROIC and Value Line, we do have more information. Yep. But it's just funny, old habits die hard. They do. I still go 10 years back. Yeah. So what I do is I find the growth rate of the EPS. Yep. And the way I do that is I will punch into the financial calculator. So we're using Dollarama, so it's 58 cents, so 0.58, and you make that a negative for the present value, or else your calculator is not going to properly work. And then you hit PV. And after you hit PV, you're going to put what the current EPS is, which is $2.62. So it's 2.62, and then you're going to hit FV, and then you're going to hit you're going to hit 10, and you're going to hit the letter N for number of periods, or in this case years. Then you're going to hit COMP, and you're going to hit the I over Y.
I over Y.
I over Y. You're going to hit that.
You get 16.28.
Yeah, 16.28.
That's
so
percent.
So in the past 10 years, Dollarama has grown their EPS at 16.28%.
Yeah, given those two numbers.
Yeah.
Yep.
Now, I'm not going to use 16.28 because they were a smaller company 10
Yep.
years ago.
They
They
had
were
much
in
more
a
room to grow.
major growth stage.
Yep.
So it would be ridiculous for me to do that. Now, having looked into Dollarama, I do know they're still growing, but obviously not by that. Now, my first inclination, if I'm honest, I wanted to use 10%. But then I was like, they've done a lot of growth already. And we're
Yep.
seeing Dollaramas everywhere. So I'm actually going to take that growth rate and I'm going to cut in half. So I'm going to only attribute them a growth rate of 8% over the next 10 years.
Yep.
And I do one stage.
Yes.
And I only look into 10 years. And the
Yep.
reason I choose to do that is because I think that if I'm going to be able to project into the future, at best I can project
Yep.
10 years.
And that's
the
fair.
business cycle changes and competition is fierce.
Yep.
So I'm going to cut that growth rate into half. So
Yep.
we're just going to attribute it a nice even
8%. Yep.
So now that we have that, the way I would do it is I take the current EPS, which is $2.62. So I would go 2.62 PV.
PV.
I'd make it a negative,
Yep.
or else it gets all screwy
It's
in the
cash
calculator.
out. Yep.
Cash out. Yeah. And then I would hit PV, which stands for present value.
Yep.
And then I would hit, we're going 10 years, so it's going to be 10. And that's going to be N for a number of years. Yeah. And then I'm going to give it my growth rate, which is 8%. So I'm going to hit 8, and then I'm going to do I over Y. Now I'm going to hit COMP for FV because that's what I'm trying to find, which is future value. So COMP, FV, that's 5.66. Now that doesn't make much sense.
Right.
But that's because we have to multiply this by the PE because we're doing earnings per share. So
share.
it's very important not to forget this step. And when I first started, I would often forget to multiply it
Right.
by the PE. And then it's like, you can't invest in anything now.
Right.
Your
Yeah.
number is so low.
Yeah.
So the way I find the PE is I find in the last 10 years, I kind of look back at what their average PE for the year was. And again, you can find all this information on lots of sites like Value Line and ROIC.
ROIC.ai. Yeah.
And all of that. And I'll take the lowest PE and the highest PE, and then I'll do the average. And so we found that the average PE, 25. Okay.
25. Yeah.
So I found that the average PE was 25.
Right.
Now I still
Somewhere around
feel like that's too high.
Right.
Because if you never know what's going to happen in the market. So I'm just going to bring it down to 20 because I feel like that's maybe
fair.
a little more accurate. And because this is called a margin of safety, well, this is a discounted cash flow, but because we're using it as a margin of safety, I want to be as critical and hard on this business as I can without being stupid.
Right.
Without being unrealistic.
Right.
Right. So I'm going to make it 20. So I'm going to take that number, the future value of $5.66, and I'm going to multiply it by 20.
Yeah.
So we get $113.13
So that's what you're assuming a future share price will be
in 10 years.
But based
now,
on these earnings.
We're not buying it in 10 years, we're buying it
Now.
So we've got to discount it back to today, which is why we call it a discounted cash flow.
Yeah.
So I'm going to clear it, and I'm just going to use 113. So we're going to put 113, and then we're going to hit FV because that's the future value. And then we're going to put 10 years. And then we're going to hit N. And then here comes that number, 15, the number we talked about at the beginning. This is my discount rate. This is the hurdle at which the company has to make over. So I'm going to hit 15, and I'm going to put I over Y. Okay? And then I'm going to hit the COMP, and I'm going to find the present value. And it's telling me that I should buy it at $27.93,
Which is
was
very similar
close.
to what I said.
And we often find that the way you do it and the way I do it, we're within dollars usually. If we're using similar growth rates, discount rates,
etc.
and all of that.
Yeah. So you can see where there's room for error in these calculations.
You can also see where there's room for, I can make it whatever I want.
Yeah. So you said, well, maybe you say, well, I think it will have a 25 PE, and
and it is going to continue to grow at 16% for the next.
And it's going to continue to grow at 16%.
Let's run those numbers.
Let's try that.
Let's run. We'll still keep the 15% hurdle in.
Yep.
Okay. We'll still keep that in.
That's our desired return.
Because that's our desired return. Okay. And we are going to get a present value of $99.86. So if we stuck to our original method and kind of punished it a little bit because we want a real margin of safety, we said we would be comfortable buying Dollarama, and this is not investing advice, for about $30 Canadian. We're looking at Canadian numbers.
Canadian dollars.
But if we massage the numbers, we'd be like, oh, wow, we can buy it for anything $99 or under. We could buy it right now because what's it trading at Canadian?
I believe it was $79.
Yeah, so we'd be like, it's on sale. Like, not only is it trading, and it's like, it's less.
Yes.
So you can really
So you can really massage the numbers.
So you have to be aware of your biases and how much you're massaging the numbers. And I think it's prudent to just always go with the lower number.
I think so.
Yeah.
Yeah. There's no called strikes in investing.
Yeah.
And so at this point, sometimes it's better to just watch an opportunity, wait for it to play out. You'll probably get your chance to buy it at some point if you wait long enough.
Yeah. And one number I never deviate from is 15%.
No,
hurdle.
no.
That never changes. I do not care if interest rates are 1.
Yep.
It stays because that protects me. That has protected me a lot, actually.
Yep. Well, especially, again, if you go back to the reasoning why. Well, the reasoning why is because the broad market itself will give you somewhere in the realm of 9 to 11% historically.
Yeah.
So again, to put all this effort in, you want to beat that. And to put all the risk in, to invest the money into single stocks.
Yeah. Now, when I will say also, when I use a margin of safety, when I'm diligent, when I read the company's annual reports, when I understand the management, when I understand the company, and when I am true and honest about growth rates and I run those numbers and I stick to them, I am always happy. And I don't want to speak in absolutes, but I cannot think of a time when I have done this where it wasn't a positive outcome, because either it kept me out of something bad.
Yep.
Right? Or it allowed me to make very good returns.
Yeah. Oh, for sure.
And I've made, every time I have really blundered, it's when I haven't calculated a margin of safety.
Yeah.
I've invested based on feels, greater fool theory, whatever.
Well, it does a few things. One, it ensures you're investing in profitable companies, because unprofitable companies you can't do these calculations on.
Yep.
They're next to impossible. Yep. Secondly, it makes you really look into the financials and seeing if there's any oddities that are there. So if, some of these, PE numbers and stuff like that can look fantastic. So you might come across a business that has like a PE of 8 or something like that. Go, wow, that's really great. But not recognizing that they had just had a one-time blip in earnings, on the upside. But usually their earnings are not that great.
That happened with Shopify, actually.
That did happen with Shopify. So there's a few things that it actually makes you reflect and look upon.
Yeah, and like I said, you really start realizing how much you do or don't understand a business when you start crunching numbers.
Yeah.
Now, of course, this being said, this is only one valuation we run, and maybe next week we can get into owner's earnings.
Yeah.
Which is
I think that would be reasonable.
This was a discounted cash flow
that
we use. And this is discounted cash flow is probably the most common that you'll hear in the investing world.
Yeah.
I think. And if you want a fun exercise, if you actually look at a lot of people's discounted cash flow numbers, they are very lenient with their discount rate. It is generally not 15%.
No, they'll often take, and Warren Buffett himself has said he takes the yield on a long-term bond as being his risk-free rate. So that's what he uses as a risk-free rate. The long-term government bonds are paying in the realm of, let's say, 4%, somewhere in the realm of that. So you could technically use 4% as your discount rate. So you could use the government bond rate and then just slash the price by 50%. You're doing the same thing, essentially.
Yeah. I think we can wrap it up there.
I think so.
This week, I hope this was helpful. Next week, we'll do owner's earnings.
Yep.
And maybe another company. You had mentioned another company that we might do it on, which is called
Alimentation Couche-Tard.
Yeah, I got you to say it because you speak French and I don't, so I knew that you'd be able to pronounce it.
It's actually quite an interesting company the more you look into it.
Yeah, so we'll run owner's earnings on that next week.
Yeah.
I hope this taught you a lot. If you have anything to add, mention it in the comments below, and if you can like and subscribe, that helps our channel a lot.